Welcome to lecture 16 of corporate finance. We are continuing our discussion on the topic of capital structure, moving towards the contents. So in previous lecture we discussed the Millar and Modigliani theory without taxes, right? So we discussed the proposition 1 and proposition 2 without taxes. So in this lecture we are going to discuss the Millar and Modigliani theory with taxes. And just for the sake of background, the theory without taxes was proposed in 1958, whereas the second theory, which is with taxes, was proposed in 1963 in a paper published in 1963. So again, as with without taxes, theory with taxes also have two propositions, which is proposition 1 and 2, and we are going to discuss these two propositions. So before we delve into this proposition 1 and 2 with taxes, one thing that I was left with, I forgot to mention in last lecture, was that we although we discussed that the WACC would not change and the value of the firm would also remain same, so the capital structure is irrelevant, and I proved through a numerical example that WACC would remain same, but I mentioned that I would also discuss that I will also prove that the value of the firm would also remain same, but I didn't discuss that. So how do we calculate a value of the firm? So the value of the firm using the corporate valuation model is free cash flow divided by 1 plus WACC raised to power n. Right? So it's quite easy to grasp the idea that if WACC would not change, right, obviously free cash flow would always remain same. So if WACC would not change, then how would the value of the firm would change? So this would give us value of the firm. So if WACC would not change, the value of the firm would also not change. So anyhow, coming back to this lecture. Okay, so that has two distinguishing features. First one is that when we increase debt, the increase in firm's debt decreases the firm's taxes, which we called interest tax shield, right? What do we mean by interest tax shield is that due to taxes, we would have to pay due to interest, we would have to pay lesser taxes, and I would numerically demonstrate this idea in a while. But keep this in mind that due to interest expense, the tax expenses would reduce. So how do we calculate tax expense? We have earning before interest and taxes. We deduct interest from it. So now we have earning before taxes, and then we calculate taxes on this specific amount. So for example, if a firm's earning is 1,000 and it do not have any taxes, so there is no debt, and if tax rate is 30%, so our EBT would turn out to be 1,000, and our tax rate of 30% on this 1,000 would be an expense of 300. So our tax expense in this case would be 300 if we do not have debt. What if we have a debt of 500 rupees? So whatever the capital we have, this is our EBIT, but whatever the capital we have some amount of debt. So for example, in this case we have 500 debt, right, and interest is assumed 10%. So 10% of 500 would be 50, right? So the interest would be 50. Now how much EBT would we have? We would have 950 EBT, and if we calculate the 30% tax on this 950 amount, then that would be 285. So now you would have noticed that because of this interest expense, our tax expense has decreased, right? Okay. So a failure to meet debt obligation can result in bankruptcy. So the idea that we are discussing here is that debt have two features. One is related to the interest tax shield. So if interest increases, the tax would decrease. And the second is the idea that there is bankruptcy. So if you remember, we had case 2, right? And in case 2, we relaxed the assumption of the taxes. So we said we have taxes, but we assume that there is no bankruptcy cost. Right? So this is what the case 2 is we are discussing. So in case 2, we have taxes, but we do not assume that there is any bankruptcy cost. This is what we would maintain here. So conclusion, capital structure definitely matters and affects the firm value when income tax is considered. So in previous example, we didn't consider, in previous theory, we didn't consider taxes. In this theory, we are going to consider taxes. So we are assuming that there are taxes in real world. So starting with the proposition 1, remember proposition 1 in each case, whether it is taxes or not taxes, let me demonstrate it over here. So we have this theory, right? There are two theories. One is with taxes and the second one is no taxes. The second one assumes that there are no taxes. There are two propositions, proposition 1 and proposition 2. This proposition 1 discusses about the value of the firm, and proposition 2 talks about WACC and cost of equity. Similarly, in no taxes, we have proposition 1 and proposition 2. Proposition 1 talks about firm value. Proposition 2 discusses WACC and cost of equity. Okay. So similarly, as was the case with with taxes, without taxes also have two propositions. So first one is firm value. So we are going to discuss the firm value case. So according to proposition without taxes, the capital structure didn't had any effect on the value of the firm. But according to with taxes, the increase in debt would increase firm value, right? Now, why is that so? Consider this tax as a cost, as an expense, right? So in case where there is all equity, the firm do not have any debt, the taxes would be higher, the cost would be higher. And in previous example, we saw the taxes were 300. So there would be lesser amount that would go towards the shareholder and the debt holder, shareholder and the creditor of the firm. Whereas in case of leveraged firm, the cost of tax decreases, right? As we saw in previous example, it was, I guess, 285, right? So the more part of this pie would go towards the credit holder and the shareholder, right? So although the size of the pie would remain same whether we have debt or not, but the cost of taxes would decrease, right? Okay. So the leveraged firm pays lesser taxes than the all equity firm. And why? We are going to demonstrate it using this example. We have firm U, which is, we call this firm unleveraged firm, and there is a leveraged firm. So this firm do have debt in its capital structure. This firm is with no debt. So imagine both have 1000 of equity. This firm have also a debt of 1000, and imagine the interest rate is 8%. So that would be 8% of 1080, right? So the taxable income in this case would be 1000, and taxable income in case of leveraged firm would be 920. If we calculate a 30% taxes, we would have this amount. Now the net income of unleveraged firm is higher than the net income of leveraged firm. So from here you would conclude that that is not beneficial. But you see, the value of the firm is what the shareholders get, or the shareholders and the creditors get. So if we see the cash flow from the asset, if you remember, cash flow from the asset is what we also call free cash flow. So this is equal to cash flow to creditors plus cash flow to debtors, or there was another equation that you would remember, it was OCF plus capital spending plus minus capital spending minus a net working capital. So imagine capital spending and net working capital are zero in this case to make things easier, and even if they weren't zero, it wouldn't affect our conclusion. Now OCF was equal to EBIT plus depreciation minus taxes. So whether we have debt or not, depreciation would not change. So we simplify the equation and we now have EBIT minus taxes. So this would be the free cash flow that would be available to be distributed among the shareholder and the creditors. So the cash flow to creditors and the cash flow to shareholders. So if this free cash flow increases, the value of the firm would increase, right? Okay. So remember the corporate valuation model, we have this equation, value of the firm is equal to free cash flow 1 plus WACC, right? So either WACC should decrease or the free cash flow should increase for the value of the firm to increase, right? So in this case, let's not talk about WACC for a moment. Just if we increase the free cash flow, then the value of the firm would definitely increase. So in this case, let's calculate the value of the firm for unleveraged firm. So in case of unleveraged firm, EBIT is 1000, which we know from here. The taxes are 300. We also know that this information from these calculations. So the free cash flow available to be distributed among shareholders and creditors is 700 in case of unleveraged firm. But in case of leveraged firm, this becomes 724. Why? Because the tax expense had decreased. So which firm have higher free cash flow? Obviously the leveraged firm. So that means if we increase debt, that would increase free cash flow, and if free cash flow would increase, then according to this formula, we know that the value of the firm would also increase. Okay, so let's have an example. So from this previous example, we conclude that this firm would save $24 each year, right? If this EBIT is yearly, then this firm would save $24 each year as compared to the unleveraged firm. So based on this information, this $24 is tax shield generated every year. So we are saying perpetual debt, right? So in the previous example, we had a debt of 1000, the tax rate and the interest rate were given. So if we wanted to calculate the present value of this tax shield, so we are saying that we would save $24 each year perpetually, right? So we have that for forever. So how do we find present value of a perpetuity? It was C by R, right? What was C? It was the cash flow. So in this case, the cash flow would be $24. So if we convert this equation, then this is the tax rate, which is 30%. This is D stands for debt, which is 1000, and this RD stands for the interest rate, which is 0.8, right? So if you calculate this, you would get $24. So this is what C is the cash flow, the annual cash flow that we would save. So what this formula is giving us, this whole formula, is the present value of the interest tax shield. So if we divide 24 by the cost of debt, which is 0.08, then we get 300. So this is the present value of all the annual tax savings, tax shields that we would have for this leveraged firm. So what we just calculated is the present value of the interest tax shield. But what about the value of the firm? If the value of the firm would increase, then we want to know what would be the value of the unleveraged firm and what would be the value of the leveraged firm. This is what we want to know. So the value of the leveraged firm exceeds the value of unleveraged firm by the present value of interest tax shield. So what this equation, this statement is saying is simply that the value of leveraged firm should be equal to value of unleveraged firm plus the present value of tax shield. And we calculated the present value of tax shield using this equation. Okay, so this would become value of leveraged firm is equal to value of unleveraged firm plus. So how do we calculate the present value of tax shield? This part of the equation. How do we calculate it? We have this formula, but this RD would cancel out, and then we would be left with the tax rate into the amount of debt. So the equation turns out to be value of leveraged firm is equal to value of unleveraged firm plus the present value of the tax shield. So keeping this equation in mind, the issue that we are left with is we know that value of leveraged firm is equal to value of unleveraged plus the tax rate into the debt, but we have this information, we do not know what is the value of unleveraged firm. So to calculate value of unleveraged firm, it would be equal to EBIT into 1 minus tax rate divided by the cost of capital for the unleveraged firm. So we are saying RU, and RU stands for the cost of capital for unleveraged firm. So this U stands for unleveraged. So the value of leveraged firm decreases as the total debt increases. Increases as the total debt increases. So now we know that according to with taxes, what is the conclusion? The proposition 1 says that value of leveraged firm is greater than value of unleveraged firm. That is good, right? This is what this theory proposed. Let's have an example. So this Divided Airlines, this is a company, is currently an unleveraged firm. The company expected to generate 153.85 in earnings before interest and tax. So this is EBIT in perpetuity. The corporate tax rate is 35%, implying after tax earning of $100. All earning after tax are paid out as dividend. The firm is considering a capital restructuring to allow 200 of debt. Its cost of debt capital is 10%, unleveraged firm is the same, so the cost of capital is 20%. What will be the new value of the, so what we need to find is the value of the leveraged firm, right? But we know value of leveraged firm is equal to value of unleveraged firm plus the tax rate into debt. We do not know this information, so first we need to calculate value of unleveraged firm, and that would be EBIT into 1 minus tax rate into 1 minus, this is multiply, 1 minus the tax rate divided by cost of capital of unleveraged firm. So in this case, EBIT is 153.85 into 1 minus the tax rate is 0.35 divided by, so cost of unleveraged firm, we are going to use the cost of unleveraged firm, which is 0.20. So this would give us an answer of 500. So the value of unleveraged firm is 500. Now we need to calculate value of leveraged firm, so that would be 500 plus the tax rate, which is 0.35 into the debt amount, which is 200. So the value of leveraged firm turns out to be 570. So now we know value of leveraged firm is greater than value of unleveraged firm. If we draw this graphically, then we would say that as debt increases, the value of the firm is increasing. So the value of unleveraged firm was 500, but the value of leveraged firm is 570, right? If the debt is 200. And if we increase the debt, then the value of the firm would also increase. Similarly, this graph is also depiction of the same idea, but this part, so this value of unleveraged firm is denoted by this line, right? And as we increase the debt, the value of leveraged firm increases, and the gap between these two is due to the present value of the tax shield. So this is the advantage of debt. In case of there is taxes, right, with taxes. Okay, so in next lecture we are going to discuss the idea of preposition to, and we are going to explore that how VAT changes with taxes.